Hi, everyone. I think welcome back to another round of session on fintechs. And this is slightly heavier one. Normally, we talk about specific areas at a high level. This is a slightly more drilled down version of it, where we are going to share how typically you should build a digital lending model. Of course, in this today's session, we'll focus primarily on a BNPL product, but the framework looks same when we build the same framework for embedded finance, or we build the same framework for for PL. Commonality is still there. Even MSME lending has worked same way for us. So the framework is largely common. But of course, ingredients will change in terms of the sharing of revenues, the data insights required for underwriting, and all that will change. But largely, the framework is common. One of the things which I kept on figuring out in last this period is that a lot of people were coming back to me saying, asking, "Ki, kaise hota hai, kaise hota hai?" I thought it may be good for us to just share it in the market. Of course, we ourselves may not be able to consult with all of them. There's also always this demand and supply issue. But I thought, well, it will be good that if some of you would be interested in looking at the template, you could and use it as it is, right? Of course, this is not a very detailed version. Otherwise, it would have taken more time. But with this is what it is, right? So the idea is to share with you a framework for sort of the building the process. The process is largely the BNPL piece, and to those who are just one second, let me get the slide in. So those who may not know me, my name is Samir Singh Jaini, and I'm part of the Digital 50 team. And we potentially work primarily in the fintech domain and BFSI domain only on the digital business side. So welcome on board, and thanks a lot for joining us. As I said, today's session was about focusing on segments. So we are going to focus on BNPL as segments. So we'll give you a quick view of it, because then we are saying that how we'll build it. If you do the same session on maybe MSME lending, maybe we'll do it very soon. We would have gone with the understanding of the market and then saying how to build it. But today's session, we will try to ensure that we understand the construct behind BNPL. What kind of BNPL also gets confused with so many varieties. I'll share you what are the varieties we see, and there are still more available. I don't want to confuse you. So we work ourselves into a BNPL for MSMEs, and that works slightly differently, but I'm again not here to confuse you with too much varieties. With this, I think we go ahead with the session. I think a quick pointer from our side. We run this fintech consulting firm, and largely we are focused only on BFSI. As I said, we've been there for 5 years. This is our 6th year. So a lot of people were doubting that consulting firm can't be built in India. And I think we have been there for a long time now. It works beautifully. So I think the work is good, and people like you are supporting it as well. We do consulting, partnership, and training and hiring, all of that, but we'll talk about later. Let's continue and focus on the content side. In terms of work, we've worked with the largest of fintechs, unicorns, banks, NBFCs, technology firms, all of them in different area, but again, largely on consulting side. And of course, there are a lot of customers on the corporate training side as well. And we obviously hire for a lot of people as well. So consulting, partnership, hiring, and training is all we do. Before we get into it, I think there's a lot of discussion around we are going through our winters. On the funding side, I think to anybody in this journey, my personal and sincere request is don't worry too much right now. Those who have a big issue are typically in Series C, and they would have enough funds to work with. I think the pre-Series A and Series A are still doing okay. I know, of course, we look at the chart. This is that actually we've done this for 90 days. We tracked in last from January to May. We definitely can see there is a downward trend. But look, between day before yesterday and yesterday, we have had flexi loans and as well as KIST getting funded. So I think let's not get worried about it. The issue on pre-Series A and Series A is much lesser. Of course, the questions which will get asked are going to be much more in the current situation, but don't worry about it. I think even if you look at the lending side, lending still hogs a majority of of the funding of it. So there is enough money on the lending side if you are building it. And we see today so many of new startups coming out here that I was actually talking to my friends saying that despite we being so deep into the market, I still don't figure out that what all deals happen at times and what all new models get created. So I think there's enough action for you to sort not to get worried about this winter. And of course, I don't know why everybody has to talk about winters in open, right? If it is winter, keep quiet and talk, manage it, right? Why investors should go out in the market and talk about it, but that's for another day. That's another thought, not now. With this, we sort of move to what are the segments and what are the areas where the funding has happened. BNPL still is a good area for funding. PL, there's also BNPL for the MSMEs, which is getting funded, and many other places. Gold loans is getting funded, salary loans, education loans. So again, this session today is primarily about saying future. If you were to build in these areas, there's still enough opportunity. And I think I remember a lot of people were asking me in 2017, 18, are we finished with in terms of innovation? And now no new startup will come in the lending area. And you see it today, new companies are coming and solving it for different segments. I was talking to somebody today who is solving heavily on the health side. And there are people who are solving for travel side. So there is some different segment getting created. So as long as you know your business well, it is fine. So just going ahead in terms of BNPL, just an overview before we get into how to build it. I think if you look at in terms of value proposition of BNPL, buy now, pay later is a very simple phenomena. Nothing exceptional, nothing very complicated about it. And even today, if you look at even today, Matthew, can you just manage it, please? Yeah. Even today, if you look at buy now, pay later, even the merchants are any which way giving you credit. If you look at the postpaid, you always were using the postpaid and then paying for it later on. So buy now, pay later by merchant was always there. And that is what is getting supported. Today, we work in so many industries, including, for example, we are with a client sitting in Pune, which is in another particular segment. And they are looking at out there in that industry as well. The merchants take care of all the credit, and that is what we are trying to replace through the credit on the formal lender side. So BNPL is nothing but e-commerce guys or merchant guys giving credit to their customers, and therefore there's a discount available. Why merchants are willing to do a buy now pay later and get a formal guy inside is that one, their credit is not getting impacted. They don't have to offer credit. Their typical transaction size increases out there at the checkout. In checkout, if you look at, there's so much of details to be put. You have put debit card or credit card number. Even UPI has a lot of overheads where the OTP comes and you invoke the app and all that. That's complete waste. We don't need to do that here. Drop in cash on delivery and growth of new customers. It always existed. So we are only replacing the informal or unstructured merchant-based BNPL. Now it is getting replaced by either lenders coming in or a specific partners who can do it. So what is the benefit from the customer experience? You click on Simple or you click on some of these platforms and you can check out. You don't need to do more. They are very similar to credit card in a sense, but there's no annual fees. There's not major documentation most of the time, not all the time. The interest-free credit period, so there is no credit at all required because it's actually underwritten by the merchant. And of course, no blockage of fund is there for product return. So if there is a product return, there's no problem. There may be a framework by which within 5 days, if the product is returned, it is adjusted against the buy now pay later line itself. So technically, there are a lot of values which exist in the BNPL side. And of course, I'm not much into stats at all, but I think we all read the Zest report, Zest Money's report on BNPL. All I'm trying to say is convey here is that the segment is growing and continue to grow. While there are a lot of discussions on overheated BNPL market where the same person has been lent too much of money, but I think I would keep it at a corner. I think there will be always risks and issues whenever anything grows. When UPI grows, there are fraud. When Aadhaar came, there's issues with it. So I think with every good thing, also bad thing will also come. But I'm just trying to say from a segment perspective, it is still continues to grow. And we have to figure out our spaces and our areas to work on. Now, if you come to a buy now pay later product, there are actually few more varieties, but I'll leave it to only 4. Maitri, can you just remove me from a host? I'm just getting screen changes. Can you remove me as a host?
Yeah.
Okay. Yeah. So let's move to the 4 models which we see today. A classical model. Is a model like a simple or postpay. Let's say simple is a classical example. They have been there for past 6-7 years doing it, and Nitya has done a fabulous job of it. but it's built for largely a new to credit customer or a convenience customer. I would not say always new to credit, but it's largely a convenience play there. But of course, new to credit can also come on top of that. Here, I think there's very little to acquisition is done through obviously as a checkout level largely, because very difficult to directly sell to the customers. Likely done through checkout page where you have your options or offers there. And credit assessment is not done using a typical underwriting cycle with the bureau score and all. You typically have whatever data you have from the app itself, or you would have been shared by the merchant, and you would sort of underwrite based on that. So there are players like Simple which are leading this thing. This is the real segment on which the BNPL was called out. I remember Nitya used to speak about it long back, and they would say, "Yeah, what is BNPL?" But that's what it is. The classical way, you basically Simple takes care of payment, settle the set with the merchant immediately or in a one day or two, charges some MDR, which is the discount rate, say 2%, 1%, 3%, whatever it is, and then it recovers from the customer after 15 days. So it's a classical charge card kind of framework. When you look at charge card, where in a high-end charge card, you basically have to pay back on a particular day. That same structure exists here, and after 15 days you have to pay, and the cycle continues. You can have a standalone version, which is like a Zest Money framework, where they actually do all the bureau checks and all. They take care, and the amounts are slightly larger as well. It can be for an NTC, or it can be for existing sort of credit savvy customer. They will go through the entire onboarding journey, bureau scores and all of that, because they would want to ensure that they're totally taken care of. And of course, this is, as I say, not about 3,000, 5,000, but much larger normally. But of course, variety will exist. Ecosystem model will be like a in Paytm or a Flipkart. You are already there. You're already doing transactions, and they are enabling those transactions on the platform. So they already have data about you. They can tie up with a lender, large lender. For example, in my case, Paytm has tied up with Aditya Birla Finance, and with them they are able to work. So when I actually buy anything on Paytm, automatically my credit line is invoked and debited and processed. And sometimes I myself get confused. Did I take credit or not? But it actually happens automatically. So it's not. Sometimes it's very difficult to figure out I took credit, but yeah, I did. And bank-led model is the fourth model, where existing bank customers for example, ICICI or HDFC, and many of these players have started partnering and figuring out that to their ETB customers, can they give them the credit? And that's what they are working on. ETB customer credit they're offering by partnering with the platforms like InstaCred. And InstaCred itself is a platform which is actually integrated with the e-commerce giant. So you are actually plugging your platform. So what ICICI is doing is actually existing to bank customers are getting lent, but they are doing tie-up. InstaCred would do a tie-up with say with like a Flipkart or Amazon or any of this, and your lines are utilized. So it's like against PL, it's actually buy now, pay later, and you don't have to do underwriting much because data is already with you. You would have done the underwriting, and you don't have to do KYC. So from a seamlessness perspective, I think bank-led model or a classical model, both are seamless, because here there's no KYC. And here there's actually KYC is still not required because it's your own customer. So, and that's a very high level view of this segment. And of course, this is more of a detailing. I would not really go much into it. But yeah, that's more of a detailing what is there. Largely a classical model is always positioned as a payment product. There's no bureau reporting. It can be on merchant checkout. It can also have an app, and would not need a lending partner, but they may need a receivable buyout because they will have receivables coming up regularly, and they must be selling that. And KYC process is not required, but others is different. And we can, I mean, all those who will fill the form will share the document any which way. So don't worry about it that you will get this access. If you fill the form, which Mehdi will share shortly, should be able to get through. Now let's come back to the pointer. Any questions on BNPL? I'll pause for a minute before I talk about how to build these platforms and processes and the approaches. Any questions you can send me on chat, or if anybody wants to ask any questions, please go ahead and ask. That will also get me some time to drink some water as well, right? So just let me just pick up some water. Am I audible or visible both?
Both audible and visible, perfectly fine.
Thank you. Thank you. Anybody, any questions, guys?
Yeah, hi Samir, Prabhat here. I just
Yeah.
have one quick question. How different are these BNPL solutions from our typical credit cards?
So framework wise, not too much. If you look at a pure classical BNPL, which is offered by Simple, it's like a small line which is running, but it's not a very large line. It is for more very basic convenience. It's not for rotation purposes, largely not for rotation purposes. So you need to pay back. Otherwise, they look like a credit card only. It's finally, credit card also built for usage. Difference is in credit card you can rotate. In this case, rotation is not correct. They don't have a lender properly behind them, so it won't work. But if you look at other segments, it can look similar by nature. Even if, let's say, pay-later guys can actually say you can rotate some money. So it's more close to a charge card than a normal credit card. I think that's what I would say.
Okay, thank you.
Thank you. Any other question before we get into the process and all?
So just hi, this is Sarish here. So just a quick question in terms of what's the percentage of people not paying back? I mean, even if it's like 15 days, is there like a study where it says that there's a risk of losing this much amount of money if you do this kind of a business? There's some persons doing this kind of a business or companies doing this kind of business.
So let me put a few perspectives and why some data may not be always right. So look, we've heard about absurd number of NPAs as well, to very low extent of, let's say, 2 to 3% as well. We have heard both numbers. We also have to look at from a churn perspective. The portfolio churns every month, some twice, right? So if you have a minor loss of transactions, if it gets multiplied, you lose a lot of capital. So it's not about a stationary, you would give it loan for a year and then you lose some money. It's okay, 1% is okay on 30% IRR. So therefore you'll make next 12%. Since the cycle is small, if you lose let's say 0.5% or 0.2% in that one cycle, you've bled, right? Because you multiply with that many factors, it becomes very large. But irrespective, I think what we have seen is that typically you go up the chain. So you tend to start with a very small line, maybe 300, 500 rupees. And it's a convenience product. So you will only go to some extent, you will not go beyond a point, right? So it is about taking to a level of, say, 4,000, 5,000 or 10,000 at best from a normal line, right? I'm talking about classical BNPL, which is not led by a lender. Here, I think NPA rates can be 3 or 4% for sure. You need to play with your other fees and as well to ensure that you make some money. On its own, just because of MDR, will you make money on day one? Not really. I think it's about creating portfolio. So what you will have is that you will create a portfolio. The way payments don't make much money, BNPL on day one may not make much money. But as you curate and get the right customer, so the right customer, if you're given the 4,000 rupees as a credit, and of course, as you grow, and I'm talking BNPL guys growing, they will have a command larger MDR from the merchants. Maybe more than 2%. You can actually negotiate later on. On day one, you're likely not to make money. NPS will be higher because as you are learning, but as you throw out the waste, for example, if you give 500 rupees and the guy is not giving you money back, he's unlikely to give you money at 5,000 rupees, but your exposure is only to the extent to whatever you lend. So it's a risk model where the instead of cost of acquisition is equal to the money you have lent to the customer, and that's how you create. So then you later on give them PL, you will give them some other kind of loans so that you can recover on long term to the right guys. So that's how the model works.
Okay, so basically what I understand is rather than investing a lot of capital into underwriting or time into underwriting, you're giving a low amount of value in terms of the BNPL. And then if there's a loss, you kind of chuck them out and you look for more better customers.
That's how, and you acquire absolutely, you acquire in large numbers. And you also churn it large numbers. You retain only the good guys who continue to pay you on time. Yeah.
Okay, perfect. Thank you so much.
Yeah, time for one more question and then we'll go into the process, right? So what we'll do is we'll run it for maybe around 20-25 minutes and then we'll be open again for questions. If there are very specific questions, you can keep sharing on the chat window. and I'll pick them up as well, right? And I can tell you that there's so many questions which remain unanswered when you are also building companies. So don't worry. If you don't have all the answers, that's normal. Yeah. Okay, so just to thought process on how to build the process. So I think at a very, very high level, broad level, I'm thinking of use case where you're trying to build a digital lending vertical in a retail space. It can be embedded finance as well. So if I assume that it's embedded finance right now, where you already have a customer base and you're trying to build a buy now, pay later product and monetize that through some third parties. So that's what you're doing. It's a one example here. When you do that, you have the possibility of using your own data and what is already there on your platform. Let's say assume that you are an e-commerce guy, or you can be a travel guy, or you can be any other guy in the business. And then based on your customer data and transaction data, can you create sort of your own XYZ score, right? So you, for example, can you build your own credit score based on the proprietary data you have, and then link it and see the sort of closeness of that to a bureau score, saying how your portfolio can perform. Idea is that since you are very close to your segment and you are talking about embedded finance, you can actually build a better score than even what bureaus can. So you can pull bureau score and link your score and then make it a better output. So I think I'll talk about it later, but I think this is where we have worked with multiple customers and we see a lot of value coming from the internal scores. And when you play over a long-term perspective, largely you will get valued from your underwriting and the scoring pattern, and you're able to collect based on your data. And therefore, I feel that this is a critical part of it, which is where whenever we go and whatever we prescribe, we always said that you should think about this, your own credit score, and you should build the analytics practice on day one rather than bringing it once the scale is there. In terms of once you do that, I'm right now looking at more structured. So I'm not about classical BNPL here. I'm talking about this ecosystem BNPL, where actually I'll partner with somebody, a lender, for this lending. So I'll have to figure out who are the right digital lenders here, what is the process, what are the other technology companies with whom we can partner for building either our own LOS or partnering, and maybe we'll pull APIs from some third party. And then, of course, it's about running the program with lenders and bureaus, aligning them all the time, launching them out. So lastly, this is the high-level approach you can think about so that we can think of cases. Of course, the first few components are critical, which is we have to figure out what the opportunities are. What is the size of opportunity? A lot of times people get into wrong side of opportunity. So they think of that everything will come to them, but it doesn't. So sometimes the overestimation, sometimes the underestimation. Sometimes they don't realize that this segment, ke bagal mein there's another segment which can be better. So, but any which way, assessing opportunity is very, very crucial. What kind of amount? So it's never perfect, but you have to start with a thought process thing that how big can I get? And where is the opportunity and who's the target? So the next immediate line aligned to that is that if you feel that in your segment there's a lot of credit opportunity, it can be for merchant, it can be a customer, it can be for this and that. So whichever segment you go in, we have to figure out what is the credit possibility. How large can it get? Is the customer base credit starved, not credit starved? If it is not credit starved, then how can we better? If it is credit starved, then what are the rates we'll get and what are the risks which we are going to take? We need to build credit products, the structure, what exactly we'll build in a very simplistic manner so that we can figure this out. And normally any kind of lending products is actually can be in one composed Excel. So a lot of times we will say that bahut mushkil hai. But it's largely in one simple Excel. You say in and out. BNPL is simply one debit here and there, right? So instead of debiting on day one, you're debiting in after 10 days. That's about it, right? So sometimes we make it more complicated, and it is largely that few debits, few credits is what it is. So you need to put a structure to that. You also have to develop a product note for it. When I say product note, I think when you think of a lending, you should not start building coding immediately. I think you need to figure out what are you trying to build, put all the constraints, and then on day one itself, as you look at opportunity, do a run with some lenders, you run with some platforms to ensure that your platform, your needs are all taken care of. At least you have supply. Only the lenders can supply that money. So you should have some gut feel before you start building the whole lending platform. I always tell my customer that on day one, if it is possible, you should run some of the credit on an offline manner, non-digital, so that you know how the system performs. And of course, a lot of times your DNA may not be a credit DNA. So would you want to learn that credit DNA as part of the process and then build? Then you have to obviously figure out the model on the revenue side. The revenue, whatever is going to get earned, it will be shared between X and Y, Z. It can be the lender, it can be technology companies will take away some money, resourcing will take some money. So you need to figure out where is the revenue and where is the cost. We'll try to give you at a very high level what exists. I'm not here to tell you share you the whole document, because you'll get sort of, we actually was just before, yesterday we were trying to cut down the deck size because it's too heavy. But yeah, structurally, you should have numbers and templates to work with. You should also focus and build your own proprietary credit framework. Very, very crucial if you want to build a lending company or lending startup. If you don't have data science guys within your company, I think your valuation will be close to zero because you're not learning. I think that's something which I'm being very, very honest. I've seen enough companies going down the range because they never looked at data enough. And of course, you need to do partnership or product launch, whichever way you do. And then program management. I think this is where many people are, that after doing all the rocking things and smart things and high sort of quality stuff, when it comes to execution, nobody likes it. I think which is where the game is. You need to keep playing this game so that you can come back and keep scaling. In terms of the assessment of the platforms, let's say if it is your own platform, you need to figure out what is the payments flowing through it. Your credit is as good as the payment which is flowing through. If it is payments which is flowing through, or if you are e-commerce guys, who's buying, who's selling, you should handle on the whole supply chain. And then if you know that supply chain, then only you can figure it out. You should also figure out the behavior of the customer through their data, right? So what is the possibility that he will take trade? Is there a gap? Is there a delay you see? What is the need? So you should talk to the customer base. You should figure out what they are doing before you start building for it. So I think it's a very simple thought process, assessing the opportunity itself and figuring out what offering can actually take care of this opportunity. So throughout process, yahan pe BNPL can work out, or it can be a PL will work out, or it can be maybe a MSME lending we can do, or we can do something else. You should have a good idea about this handle before you jump in. And would you need a 3-day credit or 10-day credit or 25 days credit? Again, it's linked to what the needs and gaps are coming up. It's simple. I think you need to find the right customer segment now. Potentially, it's possible that your platform is very large and you have, let's say, 10 million customers. But technically, out of 10 million customers, what are the first level of TG or target group you will target? So would you go for high-end guys, or would you go for low-end guys, or you will go to mid-tier? All of that is very, very crucial. As we work with few clients, we first end up figuring out where to hit, right? Because product thought process, product ideas will also change dramatically based on the target segment you have. If it is the customer is not starved of cash, he will not going to rotate the credit card. So we need to build a product like that, and it is all pure convenience. And then of course, if that is the case, then the amount of credit can be high. Then the merchant can actually give you higher discount, higher subvention. So we need to figure out with whom we are doing. If it is a small ticket one, obviously the merchant will only give limited amount of MDR, and therefore you'll have to live with the process issue that we can do only this much. So again, targeting is very, very crucial because products will be built around them. So in terms of defining the product features, I think important that we take care of the basic features like a loan amount, loan tenure. It's actually only this much. If you look at EMI is required, EMI amount, and then of course, amount, or if it is a long term, obviously in a BNPL, it's only MDR and the single debit which you'll get. There in BNPL, you have primarily, if it is delayed, there are some fines which will get attached to it. That's largely it, right? So when you look at this product, a lot of people will give saying, boss, are complications. Finally, a small Excel to be created and you run with it. Of course, when you put risks and process and all of that, it does get a bit tricky at scale. But that's again largely it. So PL would look like this. You will have a loan amount of 20,000 rupees, 12 months ka tenure hai, 12% ka rate hai, and then you have processing fee of 1%. You just put this construct. And if it is possible to get some MDR also from the merchant, it's great. If not, it's okay. And then you can figure out that overall what the customer will pay. Based on that money, you will finally end up splitting between you and your lender. In a buy now, pay later case, let's say you have a pay in 3 kind of product where 45 rupees is sort of paid for, and there are 3 months repayment. In this case, of course, interest is not charged technically BNPL, classical BNPL. an MDR is basically merchant discount rate. Merchant is going to pay for that 3 months. The merchants can even pay 2%, 3% depending on your ability to get negotiation, your scale, right? So it's again not a government controlled structure. You can actually have the MDR, which is what you are looking at. Any question? I know it's all basics, but I just want any question. Have you guys lost on the use case, or is it okay with you guys?
Very good information, Samir. Thanks.
Thank you, Vani. Thank you. Thank you. Vani, आपको आवाज से भी बताना क्या मैं? Okay, let's go.
So just one question, sir. If I can ask, sorry, this is Siddharth.
Yes.
So I just wanted to understand, Samir, for all the 4 models that you discussed, bank model, I know they charge the MDR. For the others, if you can throw some light whether MDR is being charged or it depends on the player to player who is offering the BNPL.
No, in a BNPL, the basic premise is that money has to be paid by someone. And if customer is not paying, then merchant will pay. Banks obviously will never pay, right? Why should banks pay for buying? There's no reason for it. So money is always paid by the merchant. I would say there'll be edge cases. You will come back with the edge cases that something is happening, but 99.9% it is always merchant who will pay for this MDR. It's merchant discount rate. He today also pays for a credit card. He today pays for a debit card for usage, and when his customer pays, it's the same case. So it's a replacement of same instrument by another instrument. So in a credit card, you have a payment gateway, you have an acquirer, you have a network, and you have an issuer. There are 4 parties involved. But in a classical this framework of BNPL, a simple will be the player who's directly onboarding the e-commerce guy. So he's the acquirer, he's the network, he's the issuer as well. So they take care of the entire value chain. So you don't have to distribute money with anybody else. You would be able to own everything in the structure. Yeah. So
got it.
I hope it's clear. Always merchant. Okay, let me continue.
Yeah,
Now,
Samir, okay, maybe I'll ask my question later.
Sure, give me some minutes. So I think one of the critical aspects where we end up very deeply working on is the building the product note with the client. A lot of times we've seen that some components of cost, some components of positioning, some component of sizings are not done. The product frameworks are not built for lender side, right? So finally, fintechs may think, or the embedded finance guys may think very highly of their business segment. But when it comes to lenders have their own positives and negatives. They will have their own prejudice. And net, what they're looking at is not really innovation. I'm being very honest about it. Why should they look at innovation? What they're looking at is that, will I get my money back? Will I have hassles of doing it? Will the risk be very low? If the risks are high, am I getting compensated? Or are all the trouble of understanding the ecosystem is taken care of by partner, right? I mean, a lot of times I've heard that unko to karna chahiye, they should support us. I mean, why should anybody support anyone if there's no commercial sense to it, right? So building that product document, building that APS which will lead from there. So when you pitch to the partner, of course, it'll be short deck to the CEO of the organization or the business head of the organization. So you need to ensure that you know those business heads and all of that, or a fintech case, the founders, and you should be able to pitch to them your pitch to them, saying that, boss, I have this TG. This TG is already transacting on my platform, or I already have access to them. And this is their propensity to do transactions. And therefore, in next 3 years, we believe that we can create X crores of business. And this is the path I see. If you come on board, we can actually co-create this and we can create value on it. You should be able to create maybe X crores of books on this. Now, this whole process it looks again easy, but it does take time to get our heads around it. Pitching has to take time. So typically our customers, when they say, "Ek hi hafte mein 10 lender se mila do," we don't do that. Our thought process is that you need to learn that art of talking on the credit side differently. And therefore you meet few pitch, learn about it, and then go to the next cycle instead of saying, "Oh, bulk mein 10 lo." I mean, of course, I know all 10, 20 lenders, but it doesn't make sense. We need to learn ourselves, and our DNA should change, because today my DNA can be e-commerce. Today my DNA can be travel. Today my DNA can be anything. I do need to learn about this industry much more. And therefore, credit is a very different game, right? So we need to build for that. So what will the customer journey? They should, the lender should know that where in the journey they'll need to come. Because we'll expect them to do integration with the APIs, right? Real-time APIs. So they need to think about it, saying where do they get involved? What is the possibility that they will have a lion's share of the credit, right? Because at the end, BNPL also, in a sense, in the back end, will be multiple lenders. So they should also understand on how, what kind of transactions or what percent of transactions will be shared through you. Because if they don't get enough share, then of course they will bleed, right? They will unnecessarily support you, and then later on you don't support them, right? So I think there's a lender perspective. You need to create a pitch. You need to create a pitch for the customer side, right? You need to pitch how the customer should, why the customer should take it. You need to create a pitch also for the merchant. Why should merchant take your buy now pay later? He may have other options as well. So if you are the framework I'm just trying to convey is that you need to take care of all stakeholders. Even if, let's say, merchant is you yourself, your other team will say, "Our boss, मेरे को दूसरे से ज़्यादा कम MDR मिल रहा था, why should I give it to you?" Right? So I think the fact is that fintech in a embedded finance actually has a possibility of scaling further. And interestingly, I just realized, I was talking to my team that actually for last few months, we have been working, a good 40-50% of the customers are actually on buy now pay later or a embedded finance or these kind of frameworks, but different industries. And their thought process will be same. You have to get the DNA through, they have to process through and all of that. And then we pitch to them. And when over a period of time, when pitches change, we see quick conversions, right? We'll talk about what is how do you get quickly a lender on board instead of taking too much of time. It's also important that we build revenue models out there. This is, again, simplistically speaking, there's a one Excel we will come out saying that, boss, what is the cost of doing this, cost of doing that, cost of doing this. So one side will be all the cost factor involved end to end. On the revenue side, we know that if it is buy now pay later, you can make money only from the MDR perspective. So some MDR is paid by the merchant. You would think that customer, I can charge something to customer. It doesn't happen, but if you can charge 0.5% of it, great. Otherwise, not very no. And the third component is if there is a delay in payment, you can charge some fees. Say if it is delayed by 5 days, 10 days, you can charge some fees. So this is largely the component on the revenue side. Now, this revenue will get split between you and the lender. And the lender will actually ask for obviously lion's share because it's his capital on the table. So he'll also charge a fair amount of capital, fair amount of cost to it. And then of course you have a cost of acquisition, you have the cost of technology, you have cost of this and cost of that. So largely it's a two segment. You need to be able to structure the revenue side, which is the BNPL what is the money you will get from the merchant. Then you should be able to split, saying how much money will be taken away by the lender. The lender, when it comes on board, typically when it works on unsecured line or this kind of product, will curate its own criteria, saying that I will only take this kind of customer, that kind of customer. If it is higher than 750, I'll take. If it is more than 650, plus if you can give the sort of some kind of guarantee FLDG you can give, I can give you a lower rate. So it's a game of lower rate, FLDG, duration. Shorter the duration, the lesser the chance that lenders would want to work with you. So for a 30-day BNPL, there will be more participant than a maybe 5 days BNPL because it will churn. You don't get enough opportunity to earn revenue, right? So slightly longer BNPL is more supported because of the inherent revenue possibilities there, right? So that's just a very thought process. And you need to ensure that your ROIs and all stakeholders know your investor should know exactly कैसे बनेगा, क्या बनेगा, scale कैसे बनेगा. This document can also be used also for your investor community as well. This is not to go into deeper into all the line items here, but you should put right assumptions there. This is obviously the simplest of the document we are sharing here. But of course, we need to be able to call out scenarios, which scenario, what process, what numbers. All of that will get caught into this. What percentage of leads will get into short-term, long-term, and all of that. What is the commission structure you will get? Is a longer duration, higher the commission? What is the possibility of conversion? You can also say that, boss, longer the duration, maybe conversion will be high. It's just a thought process. And then, of course, converting into human cost, this cost, maybe if you have to give some partner cost or KYC cost, all of them you will generate and then figure out what is the revenue you can make over a period of time. So just a framework. This is one of the simplest thing we thought we will bring to the table. But of course, when you go deep, it does become very complicated at times. But इनहेरेंटली इतना ही है, उसके ऊपर एक्सेल बना के मुश्किल हो जाता है. Just generically, when you look at costs, you should always look at a cost of processing a lead. There will be cost for bureau, cost for let's say verification, cost of some APIs to be called, cost of analyzing statement, ITR, all of that. One more thing you should always realize is that there is always a wastage which happens through the journey. For example, wastage can happen once you do a bureau call and then you realize it's not good. So you already spent 10 rupees of it. So let's say for every 10 customers, you convert one. Then you are 100 rupees already spent on the bureau call. So that bureau cost becomes 100 rupees for the lead. So important part is that you should be able to look at from a conversion perspective. If I just total this looks like 156, but actually if it is the at what stage it is rejected, if it is rejected at this stage, if it is rejected at this stage, the cost will keep going up and up and up. So we need to ensure that we throw out a lead as early as possible if we can't lend it. Otherwise, the cost of doing lending will increase. It can be before KYC, after KYC, before bureau, after bureau. We need to figure out what are the checks and balances we can do so that we don't increase the cost of lending or cost of the lead for us. Then, of course, you have to add all the employee cost, technology cost, APEX, OPEX, rent. You may be actually putting your own FLDG there. The lender will say, okay, give me 5% or 10% FLDG. That money, that costs money. So you can create some interest rate on top of that, saying that's the money we are losing on the table. And of course, there'll be some NPA. There'll be, if under NPA, suppose your FLDGs are likely to, so in your scenario, you can say, I've done 5% NPA FLDG, but let's say in the scenario, the NPA becomes 6%. So you will lose that 5%. So you need to be able to put that cost also in the structure. And of course, if it is embedded, then marketing will be limited. But if you are doing to do your own BNPL in the market, the cost will be much, much higher. So you should be able to figure this out. So I think this is just to assure that we don't miss it out. I have many customers, we have seen that they don't look at one component or other. So it doesn't add value, right? It's important that we look at these structures as well in deep. And of course, as I said, one of the critical criteria is when you're doing a build finance, you should and you must work on your building your own credit scoring module or proprietary framework, because nobody can replicate it. You have your own proprietary data. And on top of that, you are able to build your own underwriting logic. And therefore, your value in the market from a credit perspective is much better. We've seen that when you are in the value chain and you give credit, you're likely to have a default rates are much, much lesser. We've had cases where the amount of NPAs are much, much lesser, let's say 80% lesser than the market, just because you are inside the market, you know the data. You have a chance of doing early signs also you can figure out. For example, if the customer stops or reduces his transaction on your platform, the BNPL is still working, but you know that his propensity to use is coming down. You know suddenly his usage is increased. You may actually be troubled. Ki kya hone wala hai. So I think net, I'm just saying that over a period of time, you must build your own credit score. If the credit score holds well, you will not need to call even bureau. You can actually lend to the customer in a structured way, or you at least can have higher credibility to it. So that you don't worry too much out there. So I think, again, targeting the right customer, right pitching is very, very crucial. As the portfolio can increase over a period of time, and you say you have done, let's say ARR, or maybe you have done 100 crores of loans, at that point in time, the performance is really good. And loans are the defaults are very low. You can actually go ahead and take your own NBFC license and extract credit from your own book. So why let the credit come from somebody else? You can make more money on that. Like in any kind of business, I think you need to go work with, in this business, you need to go to lenders, you need to work with bureaus, you need to work with account aggregators, API providers, platforms, LOS, LMS, all of that. That kind of relationship you have to build. So if you're building your own team, you need to have definitely a strategy alliance guy, either a founder level guy or at least senior level guy, who manages as many relationships as possible, because these are tough and time consuming. Many guys will assume that somebody's waiting out there to partner with them. It doesn't happen. While aggregators can come because they're early stage, bureaus will take time because they are also looking at money. But lenders are going to put their money at risk and they will take their own time. And we have to figure out your use case. If your use case has limited amount of customers now, you have to work with the smaller entities rather than larger ones. In terms of commercial agreement with the lender, I'm talking about a very simplistic way. If you look at PL, in PL, they can be a fixed fee. For example, they will say, we will give you at anywhere between 17 to 19% rate to the customer, but I will pay you a fixed rate of 1.4% or 1.3% paid on a monthly basis, or whatever the structure is, or you could maybe paid upfront. The second is that there's a fixed fees. Let's say you get 1% as fixed fee, and let's say the overall lending is done by 18%, whereas the lender is okay with 15%. So there's a 3% incremental which is available. So you will get 1% plus, let's say 50% or 3%, which is 1.5. So you're likely to end up with a 2.5 rate as well. So which is better? I think I'm not trying to take here, but from a framework perspective, you have higher the customer you lend to, higher the rate you lend to the customer, better you gets to you, as long as the risk of default is not there. And of course, the third one where that lender says, boss, मेरे को तो 17 ही चाहिए, उसके ऊपर जो करना है करे, everything else is yours. I am just ensured that I make 17%. That's some of the examples we have seen in the market. And then in purely on buy now pay later, it can be a ratio between a lender and merchant can say, okay, 50-50. And that's also against linked to the IRR rate, which is there. So MDR is, let's say, 1.8%. And then because of whatever ratio we have created, there's a 0.7% goes to the lender and 1.2 can be retained. So it can be a structure which can be created over a period of time. But yeah, it's a MDR split is what you typically will get. I think, I mean, few learnings from our perspective. I think I can go on and on and go on and on. But I think largely I'll come to that point that when you develop this project, I think it's not easy to push through. So if you are running your own embedded finance company, I think one of the key things is that while Fintech should work very closely with the main business, they should also have a dedicated separate team to learn it. We need to have an effective project plan, and owner of that, the CEO of the company should actually be tracking it. You should have a great governance plan, because we feel that most of people don't have good governance framework review process. They should have a clear milestones, which is more like a program management. That's what we do. But too many stakeholders are there, right? There's a customer, if there's a merchant additionally on your platform, that is then your internal teams, then your embedded finance, your mothership company team, then lender team, the payments team. There's a lot of things which get involved. Not easy to run, but yeah, you need to run your ship very tight. And post going live, I think what you should do is curate your portfolio, ensure that as the portfolio performs well, you go for a larger larger lenders who give lower rates, keep scaling it up. Deeper integration you should do for improving the journeys, add more services, more products, more services, more journeys, relook at the commercials, because sometimes you would have got adverse numbers because we were too small. You may also have opportunity to do innovation on the credit side. So I think that's largely what I wanted to talk about. We'll obviously come to Q&A, but this is our core strength. We have been doing this is our 6th year. We've been working primarily on digital advisory side, helping startups in building their journeys, products, neo-banking piece a lot. We are working on a very early stage companies to a Series A, Series B, Series C companies in their services. Sometimes we are only advisors. Sometimes we are operators plus advisors. We have done all those services. Security and compliance is good. So in our company, so we actually can help you in building it up from a security and compliance perspective as well. We do a lot of curation on content and search. So sometimes we help the companies in researching on the market on sites. And of course, open banking is a big strength for us. We have been training the market around that. I think a good 40% or 50% of the founders would be also from our class. And we'll talk about that as well. I think all those who are looking at some meetings, I mean, as long as you are a founder who has some experience in it and you want to meet us, because we also want to meet early stage startups a lot. So we would love to meet you. And if you have challenges, I think you can give a feedback. And Matthew, you should share the linkage to the feedback form, and please fill it up. And we'll share, if you need a meeting with us, between me and Shashank, we'll figure it out. And we do that. Of course, if you are looking for this tech as well, we can share this as well when you fill the form. In terms of a few things ahead of us, which is on 17th of July, we are starting our, again, long-term training, a 2.5 month long training on fintech, open banking, and financial blockchain. I think this is our fourth batch. I think the people have done really well. We have seen people becoming founders, people leading their businesses, people actually taking leadership role in the digital domain. We have even seen people changing streams from a tech to business side as part of the journey. So this is not a pure tech course. It's a course where business guys can understand how the fintech journey can work. So it can be digital guys, it can be bank guy, it can be an NBFC, it can be a wealth. We have seen insurance for guys coming. Also, a lot of investors come in these sessions and be part of it. So that's one which is coming up. You can reach out to Shrikant and take it forward. So that's one big program. Of course, it comes every three months. One change we have done this time is because we know that we are going through a different stress, which is sort of post-COVID, pre-COVID. I don't know if COVID is back or not, but technically the offices are still open. So we used to run on every Sunday for 16 weekends. We have reduced it to more like a 10, 11 weekends, 10 weekends, I think, overall. So you should be able to finish it in 10 weeks and 2.5 months. And of course, we have recorded a lot of content to ensure that you can use this. You don't need to go to some basic session with us. You can pre-read on your own. So we are trying to accelerate the process rather than taking 4 months. That's again a feedback from the market. And then we are launching our own fintech school, and where the point is it'll be all fully digital. While executive program is all about talking to you and meeting you like this one-on-one, and we will have a lot of external speakers coming out meeting you. This one is more of you getting access to the modules and documentation you can go through. We will also get access to the fintech experts also coming to you for one-on-one sessions. So there will be webinars for you. We also run a hiring community, right? So we can actually figure this out, or market research reports, all of that will be available. And of course, we were big before COVID in events. We have become online events we do, but we'll keep doing networking session as a team, and we'll figure out. So this is a self-paced program which is launching soon. If you're interested, you can share on the link as well. And with this we stop now, pause now, and please share your feedback. And now we are open for Q&A. Happy to take any question. Let me see if there is any question which I can see. I can't see right now any. But please go ahead and ask your question, please. And you can raise your hands and I will actually call out, whichever way it works. Yeah. Or it is all clear, then also it's great, right? So no worries. Anything you want to ask in this session? I think we are in last 10 minutes, 12 minutes.
Yeah, hi, Samir Prabhat here. So one question I have parked.
So Prabhat, what good if you can quickly give your background so that at least know the context.
Yeah, so I have been a banking professional from last 18 years. Okay. And I've worked for various multinational banks across the globe, the last being working with Mashreq Bank in Dubai. Okay. I have interest in fintech, and that is where I have joined this call. I'm trying to do a startup in this space. So, the question that I have parked, Samir, was basically when we are talking about credit card, we talk about the card network that exists, right? How do you see a similar thing happening for BNPL? Do you foresee a BNPL network also coming into play with so many players coming into the ecosystem that you have one set of BNPL provider who could be issuer, another set who could be acquired, just like how it works for credit card? What are your views on that?
No, I think, look, every network is trying to build that because they're getting replaced. So logically so. But I think the current players will have a advantage of being there for some time, and they may have a loyal following. So yeah, of course, my personal belief, and I've been telling for a long time, not that everybody listens. I think the country needs credit network more than the payment network. Payment network exists, right? I don't deny. In fact, I always believe that when we were talking about, RB was talking about that we should have a alternative to NPCI. I was like so worried. We don't talk about lending. We are trying to solve what is already solved partially. We are over solving it. There's a need for lending network to come up. So definitely, I think this credit and I remember writing something on UPI credit long back, 6 years back, 5 years back. It is of course required, right? It is strange that we don't have it, but it's time for us to build a network for credit as well, to make credit as easily, as seamless as possible. Yeah, I think you and me on the same page.
Great. Thank you, Samir.
Thank you. Any other questions, folks? Yes, Siddharth.
So, Samir, this B2B as a category, sorry, this BNPL as a category, we always go for B2C kind of models, but then there are some players who are coming into, B2B category as well, like credits and all. So, what do you think of, success criteria for these kind of players, B2B BNPL? Because B2C is a very common thing, but B2B is something, they enable at the checkout pages and all. So, what's your view on that particular area?
I think my personal take is that that segment will grow. We ourselves are working on a couple of similar initiatives for our clients. Technically, if you look at in B2B business, one B gives credit to the other B, right? So there's always this chakkar ki, basically when I offer you service, I give you credit free, right? So no merchant wants to give that credit because it's their own working capital gets locked. So technically they want to release it. And this is where if we can replace that with the credit coming from an organized segment, that will be much better for them, right? So I think it's the market is getting ripe and wherever I see and most of our customers. So incidentally, I'm just trying to tell that all the customers talking to us are moving towards B2B, right? B2C is solved to some extent, right? We know that something is there. In B2B, the most trade is locked, right? For example, I've given service to so many people. My money comes after maybe 1 month, 2 months, right? So there's always money getting locked. So that is getting resolved through this process. Supply chain mein pakad lo, kaise bhi pakad lo, it's always there. So B2B mein BNPL is a humongous opportunity. And it's more complicated because you need to learn about the DNA of that segment. How fuel segment works is different from how, let's say, steel segment will work. So every segment you get into it, you need to know the nuances so that you can actually underwrite properly and process properly. So I think this difference is there. And I personally believe that there will be much larger business getting created on a B2B side, on a BNPL.
Sure.
And slightly less risky, right? Because there your ability to understand the data is much better. But you need people who are from the ecosystem. You can't say that I'll get a normal credit guy and put it into each segment. Nahi hoga. We need specialists.
Sure. Thank you.
Any other questions, guys?
Yeah, hi, Samir. I wanted to ask about the OCN, that is the Open Credit Enablement Network.
Yeah, go ahead with the question.
Hello.
Yeah, go ahead with the question. What exactly is the question?
No, the question is your thoughts on the OCN, like how evolved is OCN and how does it work at a high level?
I think so. My personal view is that, of course, OCN is about standardization of APIs. To that extent, it works well. They have been trying to make it work for some time, which is all good. I think the challenge I see is we are missing the NPCI in the in between. So we need to have a mediator at scale to help in the acceleration. So which has to be maybe naturally a government-owned entity or government-supported entity. So we don't have it. Look at at least something similar to that. We have, for trades, they give licenses to 3 players, and that is working out well, right? So we need somebody on the middle, on the network side to work. So that is actually a network without a network player in between. We don't have an entity who's running the OCN, and of course they're changing the process. But I think where we need to, RBI needs to kick in, and the government needs to kick in. They should designate an entity to build that network, and then life will become much easier. So OCN is a great framework and standards, but I think it's some time to evolve into a scalable model. They're still working on Sahai and others. I'm absolutely pro it. I love the work they do, but there are gaps which can be filled. Of course, like any products, it does take time, right? I remember in UPI, we were working in 2015. In April 2015, we were pitching this product and we were doing the first POC. To the time when people market came to know, it was on 2016 end when we were talking about demonetization. It does take time to reach there, but yeah, it'll happen.
All right, then. Thank you.
Thank you. Any other question? Keep giving us feedback. The link is already there. Yeah. So I think the question I saw from Asif was, how do you do socio-economic profiling of selecting a target group in BNPL? Look, I'm not the biggest expert on socio-economic profiling. Okay, but what we do that is we look at the customer data points. We figure out maybe exactly not in these words, but a lot of times not entire data is available. A lot of times the customer data, the way we capture on day one, is not as good, because we are not thinking from banking perspective. The data is there to the limited extent. We know the location he's staying, some information about him. Beyond that, we don't know. We only know what transactions he has done prior to this. So I think it won't be foolproof. We will go with the gut feel. As I said, in BNPL, you know what you know, and do a low amount of credit to it, and let the credit play to it. We will not try to do too much of analytics on it, because वो कुछ होगा ही नहीं, फिर उसके बाद सारा control हो जाएगा. So as I remember, one of the leading founder told me that in the business model they went ahead, they initially, as much as possible, doled out money in the first cohorts to as many as possible without thinking too much of a small amount. Idea was to figure out who doesn't pay, and then tighten the progress. Otherwise, you will be biased against someone, because in the past, somebody, for example, some people say that cattle loans are never returned, right? It's always high default. We work with a client where the defaults are almost zero, actually zero. So it is possible, based on your data analytics, you can prove something other way around. So it's important you do it differently. I would focus on your data and your profiling and your process much more than just the social side. I mean, that, again, I'm not an expert purely on that, so I would really go there. Any other questions, guys? So I think my sense is whatever I think the message I wanted to give was how to do that. I've shared. If you need this document or presentation, please share the feedback. We'll share it across to you. And of course, we'll be happy to see you in our executive program, which is starting next month on 17th. Or if you want to join our online trainings as well, which is more purely virtual, purely recorded, and which is the ecosystem place, we will be happy to work with you. With this, we close. Thank you. Thank you, everyone. Thank you.